In this lecture, I want to explore a few of the many facets of the V pattern. As you may know, chart patterns or price action patterns have gotten a bad reputation over the years, and the reason is because the classic way of trading them is unreliable and imprecise. However, these patterns do have a behavioral element to them, and a small subset of them can indeed be traded successfully. That is the case with patterns such as the double top or bottom and the V top or bottom. Some traders end up specializing in one market scenario, and they only trade when that specific scenario appears. The problem with that is that the frequency of opportunities ends up getting reduced. The solution is to scan for that particular scenario across multiple markets and timeframes. That way, you are always scanning for the same thing, but you are expanding the number of opportunities you get. This is the classic setup trading mentality. Contextual analysis involves a more nuanced and sophisticated approach, but it allows you to read any market in any time frame on command. We'll explore both worlds here, the setup trading mentality and the contextual trading mentality. Not all setups are created equal though. Most setups are just too simplistic and therefore unable to grasp the true level of complexity of the market. In any case, the V pattern is one of the trading techniques that can be used in the setup trading paradigm. The idea of this lecture is to explore the different types of dynamics that lead to good and bad V patterns. The V pattern is simply a sharp price movement in one direction followed by a sharp movement in the opposite direction. The way to trade the V pattern, of course, involves detecting the subtle dynamics of how price transitions between one sharp movement to the other. The great thing about this pattern is that this transition is usually easy to see. We'll of course also observe examples that lead to failures. There are many ways of being misled by even such simple patterns like this. Let's begin by taking a look at a very clear example. This one happened in the 1-hour S&P. Price initiates a movement down with greater volatility. In this case, the rise in volatility is explicit. After a couple of bearish candles, a strong bullish candle appears. For the students of my previous courses, there are a few details that draw our attention here. First is the smoothness of price action that emerges with the sudden rise in volatility. The second detail is related to the dynamics of the V pattern. The appearance of the strong bullish candle is the first evidence that the V has reached its bottom in this case. Pay attention also to the range dynamics here. Price action transitions from clear downward progressions to an upward progression. There is no smooth transition to contractions in this case. This absence of a more gradual transition is clear evidence that price is changing faster than is generally expected. For V pattern traders, this is the moment where the good old question emerges. Is this the moment to enter, or is more confirmation required? Of course, it's very hard to provide a black and white answer to this, because the answer depends on your risk tolerance, and each trader has a different level of risk tolerance. Risk-averse traders will obviously wait for more, and risk-seeking traders will jump in. However, all the confirmations you could want might have already happened. It's a problem of being able to recognize them. This is where the superposition of different frameworks of analysis will aid in your decisions. Just looking at the V pattern itself is possible, but this is the problem you run into constantly. For fractal flow traders, there's also the question of whether one should wait for a dynamic frequency breakout to the upside. There's also the question of the volatility of the dynamic frequency breakout. The higher the level of volatility in the DFB, the larger your stop loss will be, and that means price action has to travel greater distances to justify the trade opportunity you take. This is always the problem. Now, in this case, if you waited for the DFB, the trade would obviously work because the V bottom happened in the first retracement of an uptrend. But there is absolutely nothing that stops this exact same scenario to occur in the last retracement of a trend. In the second case, you would be in trouble if you waited for the high volatility DFB. That leads us to the problem of identifying the trend phase in which the V pattern occurred. You can get away with more unreliable entries if you trade in favor of the trend. That's an intuitive notion to most traders. In any case, let's go back to our focus here and detect the different kinds of dynamics that happen at the turning point of the V. In this case, we see a downward progression going directly into an upward progression. In this other chart, we see a violent downward movement composed of bearish candles only, eventually leading to a contraction in the form of a bullish candle. In other words, a bullish inside candle after a downward movement like this is a red flag for V-pattern traders. This is what is known as a hook in classic technical analysis. An inside candle after a violent movement that stands out because of its change in bias. The classic entry in this case would be to wait for price to break the high of the inside candle and then put a stop at the lowest point of the V-bottom. Notice that this doesn't happen though. The next candle forms a downward progression while being a bullish fractal candle. Notice also that the fractal flow traders wanting to enter to the upside because of the fractal candle will have an additional layer of confirmation here due to the prominent lower shadow of the candle. In the next candle, a contraction happens again, and for the traders that didn't enter in the hook or in the fractal candle, another chance emerges. The entry here would be similar to the hook, a buy stop order right above the high of the inside candle. As we can clearly see, this would be the final opportunity to enter before price took off to the upside, rendering this a successful V-bottom. Notice how different this was in comparison to the last example where price simply transitioned from downward progression to upward progression and took off. Even though both examples are V-bottoms, the dynamics of how they reverse were completely different. If you're not aware of these small details, it would be difficult to decide what to do in real time. Let's look at a different pattern in a different market. In this chart, we have the Euro-USD. We now look at a V-top. First thing that draws attention here is the acceleration of buyers with a massive wide range candle. In the case of a V-top, the trader would not start to look for signs of reversal until a bearish candle appeared. In this case, the first bearish candle was a bearish fractal candle. After that, price forms an inside candle, and in the next, a DFB with low volatility to the downside. Once again, pay attention to the smoothness of the transition and the fact that the DFB occurred with low volatility. This is what we classify as a DFB under the butterfly effect. Here we have another example of V-top, but now in the daily chart of the pound USD. Notice that the upward price movement that forms the first leg of the V-top is composed only of bullish candles, with one small exception. At the very top, price forms a downward contraction, which is when price produces a flat high and higher low from one candle to the next. Right after that, we see a downward progression that also happens to be a low volatility DFB to the downside. This is a very smooth transition. First, the highs of candlesticks stopped advancing while the lows were still going to the upside, and then both ends of the range dynamics turned to the downside. Let's now look at an example of failure in the V pattern, observing an example in the 30-minute gold futures. Here we have what appeared at the time as a good V-top. We see 5 consecutive bullish candles accelerating to the upside, and then we see an inside bearish candle signaling once again the hook reversal. The classic entry would be a sell stop order just below the low of the inside candle, which would be triggered in the next candle, and the stop loss would intuitively be above the highest point of the V-top. In the very next candle, the stop loss would have been hit by a bearish fractal candle whose upper shadow creates a bull trap in relation to what was the V-top pattern. This is the unavoidable and deceptive mechanics you can find in patterns like these. However, if you waited for the DFB in this pattern, which happened exactly at the fractal candle that formed the DFB, you would avoid being stopped out by the small bull trap. We see how the DFB would act as a filter here, but this is not the only problem with this V-top. Notice that price doesn't go too far down after the DFB, and it ends up stopping at a support line, as you can see here. This is of course the problem of trading against the trend. While V-patterns are common patterns in very prominent reversals, you never really know if the trend is over until it's too late. So this is the kind of problem you can run into. In this case, a short trade after the fractal candle with a stop above the bull trap could still be saved by moving the stop loss to break even when price hit the support and gave indications that the uptrend would resume. Once again, even in trading a very simple pattern like this, we can see how price action can find different ways of deceiving us. I believe that it's clear at this point that even a simple pattern like the V can unfold in multiple ways, and no matter how much we generalize the elements that are always present, the dynamics of how reversals occur can find a way to mislead us. The goal of this lecture was to show you some examples of success and failure, but of course the fractal flow method emphasizes the use of other elements to help increase the odds of success in a trade using the framework of hyperintegration. For example, in the example of failure, the notion of trend, other forms of support and resistance, and the bull-bear trap pattern that began with Wyckoff would raise doubts about the validation of certain V patterns. This is what integrated fractal trading is all about, getting a more realistic sense of the imperfection of price action and deploying a 360-degree view of technical analysis to understand how we can increase the chances of success in any given trade. In the context of our method, the V pattern would simply be one pattern to spark the analysis at a specific point in time and price. After the detection, other forms of analysis would be deployed to confirm the pattern. The point is, since the V pattern is a simple thing to spot, it can be a great way to start the analysis. It's tempting for some traders to simply narrow down their analysis to one thing like the V pattern, but as you can see after minimal examination, it's not that simple. The bottom line is that the simplicity of a pattern like the V serves as a gateway to the rest of the analysis, an initial anchor only.